All right, so let's get started. I really appreciate you guys taking time to come out. As you guys know, this is an annual event that we do. And it's really important, as you guys might walk in and say, why are we here today? I know it's not the Subway food, but why are we here? And trying to figure out what in the world's going on with this market. As I've told many of you in the past, I might not know any better than you do. However, we've put together some resources to try to get an opinion that we believe is pretty solid. And we're going to talk about that opinion today. But it is an opinion. And we're also going to talk about some goals and different things like that today too. So I really appreciate you coming. As you guys know, Sean and the rest of the team, we joined LPL Financial several years ago. Investment Centers was sold. This is our legal disclosure with LPL. They're a very large firm. They don't advertise. There's 17,000 advisors, roughly, that fit underneath their hood. They're the largest independent shop out there. So think of Big Brother that overwatches what we do. That's what LPL does for us. And so there's our disclosure. All right, so today, here's what I want to talk about. How did stocks do in 2019? We have a pretty good feeling already, right? They did pretty well. But then what about 2020? So we're going to talk about what performance, what drove it, where are we now, and then what are the experts, what are the financial experts thinking that's going to happen in 2020, and then what are some of the research that's involved with it. So here we are, guys, 2019 S&P 500 target. This was at the beginning of last year. These were Morgan Stanley and UBS and Bank of America. These were the experts and what they thought was going to happen to the market. We started the year at 2549 on the S&P. The S&P 500 is 500 large cap U.S. stocks. Okay, so it's an index of 500 stocks. The price of the index was 2549. It closed at 3231. It was up 28.88% last year in the S&P 500. It was an amazing year. What's interesting is you take a look at it, finished at 3,200. Some of these weren't too far off. And the reason why they expected such a big increase is, remember your statements, December, the fourth quarter of December of 2018, it was pretty difficult statements. We had the Fed, which we're going to talk about, that had raised interest rates. People got negative and the markets went negative and we lost all our gains at the end of 18. So they expected 19 to be a pretty decent year. Obviously, not very many of them got to the 3,200, but they didn't do it too bad with it. The year prior, going through this slide, if you were here last year, they were way off as far as the returns were considered. All right, so what drove that performance? So monetary easing, trade, corporate earnings, and the economy, and we're going to touch on those now. So monetary policy, that's the Fed. As we talked about, the Fed raised in 2018, and then they had a change of face, and they started to decrease rates last year. And they did it 3 times. And they didn't know if they would do it at all, but we started to see those decreases happen. You saw it happen in July, September, and October. They did 3 cuts. For this year, they're neutral. There isn't a cut that's expected for this year, but we'll see what happens. We'll see what happens with this economy. But that definitely drove the market. From a standpoint of where you were going to be, where the Fed were raising interest rates and your mortgage loans, we have a couple bankers here today, mortgage loans and things could get more expensive, to all of a sudden rates being reduced and it was easier to borrow money or have lower rates when you were borrowing money. That made a difference to these corporations, and it made a difference with what happened last year in the economy. And then trade. Trade, everywhere you look, is trade. And the markets bounced off of trade both negatively and positively last year. And these are just to highlight some of the things that had happened. But on 24th, Trump announced the U.S. tariffs targeting China. And then on May 5th, he threatened the tariffs on $300 billion. On June 7th, he called it off with the Mexico imports. On August 5th, he labeled China as a currency manipulator. Then on the 11th, they had the Phase 1 trade agreement that was verbally kind of agreed to. October 18th, they imposed tariffs on $7.5 billion of European imports. So we're going to talk about trade later on. And then on December 2nd, announces reposition of tariffs on steel and aluminum from Brazil and Argentina. This whole discussion about trade is not over. It's going to continue on into this year, and you're going to see positives and you're going to see negatives, I believe, with the market the way it acts. We're not here to debate the merits of good, bad, or different as far as the tariffs are. That's more of a political view. But I am going to tell you that we don't believe that this thing is over at all. All right, so let's talk about gross domestic import, and then let's talk about exports. This is going back to 1950, and this is showing how much of the goods and services that we export. It's 12% of our GDP. You can see kind of what has happened here in the 70s and 80s and 90s, and it's kind of gone. And then you see the line go down because of what's been going on since Trump's been elected and kind of working on these tariffs things. But it's 12% of our GDP. It might be one of the reasons why we didn't see a lot of negative with the trade talk and the tariffs. It might be the reason why, because it's only 12%. It is a piece of our economy for sure, but it's not 50% of our economy either. And so this just outlines kind of where we were. Look where it was at the beginning of 50 on how high it was, had went down, and then it's just gradually gone up. But I thought it was an interesting slide to share with you guys on where we at with all of our gross domestic product versus on the exports. So where are we now? These are some of my favorite slides, and they're busy, but they're my favorite because I do colors and I can understand colors. Red is not good, yellow is yield, and green means go. Things are good. So this is taking a look at December of 2008. If you look at December of 2008 and you look at all these different economic and financial data points, it didn't look good. You had some green and markety in top left corner in market and equity valuations. The stock market had started to go down and the cost of stocks were cheaper. That was good. But there were a lot of things in 08 that weren't good, and we know about the Great Recession we went in. So we pair that 2008 slide with the beginning of January of 2019. So this was, if you're sitting in this room last year, this was the slide that we would have looked at to show where are we at going into 2019. What do things look like? There's two red things on the slide. Political environment. I bet you that's never green again. It doesn't feel that way, does it? Doesn't matter who's in office. It's going to be red for a long time, I think. In geopolitical risks, things overseas, those things have heightened over time as well, and that was red. We've got a couple yellow economic indicators that are there, housing and mortgages, as the Fed raised interest rates at the end of last year. If you're going to start to pay more for your house loan and things like that. You had monetary policy, and then you had international economic outlook. So that was the beginning of last year. Here's where we sit today. There's some more yellow. But we also just have these two red. Right? So the question is what becomes of the yellow indicators that are there? Because if we go back to January of 19, we had 3 yellow dots on there. And if we look at it now, we go to 3, 6, 8 that are there. So what that's telling us is that things are getting longer in this cycle. And we've been saying it, Sean and I have been saying to our clients and you guys for 3 or 4 years, like, this thing's long in the tooth, but it's continuing to go on, and we're going to talk about, do we think it's going to continue for this year? But it's an interesting slide that we're starting to trend a little bit. It's not red, but they're yellow. This is an interesting slide too. Don't try to read this whole slide because you can't. Again, it's color, okay? Red's not good, green is good, and yellow's in the middle. Take a look at 09 and look at all the red. These are all the different international, I got US circled there, but those are international countries. And it's looking at the economic indicators in a lot of different areas, and you can see a lot of red. You can see here that we were green. Look at all the green in 17 and 18, and we're starting to see on the world stage a little bit more light green, yellow, a little bit of red in there too. That's starting to indicate that this is getting a little bit long in the cycle. All right, let's talk about headwinds. So what are some of the things that we're facing that could be headwinds that could hurt this market as we look at today going forward? We've got the business cycle that we're in. We have slowing global growth. The trade policy certainly can be a headwind. Higher volatility, I think we saw that. Sean and I talked about it in Colby just this week on how all of a sudden we were up and then we were down 3% for the year, and now we're back up for the year. It's been a little bit more volatile. We got the 2020 elections. Obviously, people can be polarized around elections, so that could be a headwind. Acceleration in wages and other businesses' costs. So as people are starting to make more, you got corporations that have to pay those wages. That could be a headwind. And then geopolitical shocks, and I think that's probably going to be on every slide moving forward. What are some tailwinds? So what are some things that are helping this economy? You got the Fed has a dovish pivot, meaning that they are just being neutral at this point. We had the raise in 18, we had 3 cuts last year, and they're just basically saying neutral and watching this market and what's going on. So by them not wanting to raise interest rates, that's typically good for the corporations. Corporate profits, so this is an interesting one. In 2018, we had really good profits. So in 2019, they were difficult to beat. They've been readjusted. And so we think that those earnings beats, when it comes out and it says XYZ company beat by 2 cents a share or whatever, we think that those companies have a better chance of beating them this year because it's more depressed than it was in 2019. So we actually think that corporate profits should look good this year. The consumers are healthy. The people seem to be happy. When you take a look at the VIX index and people's emotions and things like that, for the most part, people are spending money. That's a good thing for the economy. Solid business fundamentals. Housing's good. 2020 election could be a positive. Depends on your point of view. Favorable financial conditions, and then moderate inflation. That's a big thing, is we just haven't seen a huge step in inflation, which is a good thing. Price to earnings ratios. So I talked about this last year. Let's say that I had a coffee shop uptown, and you were going to buy it from me. And that coffee shop made $100,000 of income this year. That's what we made on the coffee shop. What would you be willing to buy that coffee shop from me if I made $100,000 of profit this year? Would it be 5 times that? Would you give me $500,000? Would it be 10 times that? Would you give me $1 million? Because you know you're going to get your 100 and hopefully grow it. What would you give me for that coffee shop? That's what the price to earnings ratio is called when you look at stocks. And we look at that ratio because we want to know if stocks are getting more expensive to buy or if they're cheap to buy. And so what this is showing, the 25-year moving average is 16 times earnings. So it'd be $1.6 million that you would pay me for the coffee shop if you look at the historical stock market. 16 times what it made. But if you look September 30th and 19, we're at 16.82. We're about online with average costs for these stocks. You go back and look at the standard deviation, which is 1 step up and 1 step down, and we're within these lines that are pointed here. So all this is saying is that we don't believe that stocks are overvalued at this time. And we can go back and look at 2000, and you can look at the late 80s. You can kind of see what had happened with these stock prices, and you can see what happened as we went through the Great Recession. All of a sudden, stocks became cheap based upon their earnings. So what's the 2020 forecast? So I have a couple slides I want to show you, and I really like these as well. So this goes back to 1996. This is the S&P 500, so those 500 large cap U.S. stocks. This is the chart. Okay, you can see we're down 49, down 57. We all remember that. We felt it in our pocketbook when the markets went down. And then you see this next run up, 378%. So when you look at this chart and you go back to 1996 and you grab one of your grandkids and said, where's the next arrow on this chart? Where would they draw it? Probably down, wouldn't they? But what about this chart? This is going back to 1900. It's a little bit different perspective on the market. And you can see that we were flat. You look here to here, and we were flat. We had ups and downs, and now we've got that run that's up. So what would they draw here? It might be a little bit harder for them to figure that piece out. So again, it's perspective, taking a long-term perspective. and also saying that there could be some room left in this movement. So how do Sean and I and Colby and the team deal with this? So we have a tool, many of you guys have seen this. This is called Riskalyze. It's a tool that we subscribe to. We've used it probably for 3 or 4 years. And if you haven't seen this, give us a call. Let's get your portfolio in and take a look at it. But here's what's really interesting about this tool. It'll give us a range in a 6-month time period on if the market was really bad, this is what you could expect. And if the market was really good, this is what you could expect. And what's really interesting is we had a really bad fourth quarter of 2018 and a really good first quarter of 2019. And when we went back and looked at the portfolios that we were managing for clients, we saw that they were within that range. And so if we can get you to give us your answers on what risk you're willing to accept, it makes it easier on us to put together the portfolio that we're willing to live with if all of a sudden the market was down for the next 6 months. So really important tool. Just wanted to make sure that you guys have seen this. Most of you probably have, but if you haven't, call us. Let's get your portfolio in there and let's have a conversation about what your 6 months range. This 53 score is down 10 or up 16. That's the range that could happen in the next 6 months to a 53. If you're all in that S&P 500, it's a 74. So what's your number? And we can take a look at that and make sure that we have one assigned to you. This chart's been on these slides for a while, but it still holds true to this day. It's a busy chart, but it's showing that the 10-year Treasury yield today, it's under 2%. I think it's 1.68 or something like that. The 5% red line that goes up and down, what this is saying is when the Fed raises interest rates, if it's not above 5, typically the stock market raises with it. And so if we're down in the 2s, if the Fed did raise some interest rates, it's also not pointing to the fact that the stock market should go down if the Fed did that. Now you might say, well, Brad, what happened in 2018 then? Because the Fed raised interest rate. But I think that there was just some profit and some harvesting that was going on as well. But obviously we're in that top left quadrant. That's where we want to be, and that's where we're at today. So what about a recession? Everybody's talking about at some point there has to be a recession. And on average, every 5 years we have a recession. And we're like, 8, 9 into this thing without a recession. But a recession is classified as the economy not growing, that it shrinks 2 quarters in a row, and we're technically in a recession. This is taking a look at Q4 of 2019. The GDP grew at 1.7, and taking a look at the predictions for Q1 at 1.9, Q2, Q3, and Q4. You have unemployment rate at all-time lows and so on and so forth. 5% typically is unemployment. If we have 5%, we don't have an unemployment problem. We were up in the 10s back in the recession that we had. You were in the 25s in the Great Depression. But at this point, with low unemployment and GDP, these indicators look like we don't see that recession this year. But yet we also have those yellow that we looked at. So there's something kind of going on there, but it's not like it's imminent, like screaming at us that something is on its way. Unemployment and wages. So we have seen locally and nationally, we have seen raises that are going up and above what the economy is growing at. It's called wage inflation. And if it goes too high, that can be a negative effect on corporations because they're paying that out. But we're starting to see that, and this is an indication of what that is. And you can see it ebbs and flows. And then this is the unemployment rate as well. And those are starting to converge at this point. So you can see October 09, 10%, 3.5, and we're at 3.5 here. Historically, it's about a 4% wage growth and unemployment around 6%. It's just indicating that people are getting a little bit more in their paychecks from their employers, and that's a healthy thing because people tend to spend their money, and that's good for Walmart and Charlie's Hardware and whatever, wherever they're going to spend those dollars and cents. So what do the experts think this year? So some scribbles up here, but 32.31 is where we ended the year. These were put together on November 23rd of 2019. So around Thanksgiving, Morgan Stanley, UBS, Merrill Lynch, they came out with what they thought was going to be the target on the S&P. This is where we ended yesterday, 33.57. They're at 3,400, 3,400, and 3,425, and the other ones are even less than this. That's an indication of the rise that we've had, but these average about 5%. If you take a look at what they thought was going to happen, they thought we'd have about a 5% gain on the S&P this year when we look at the consensus. So big picture, we don't think a recession's around the corner tomorrow, and we think that there's modest gains, but there's increased volatility that we're going to see in this market. That's going to continue to show its face. So volatility. I really like this slide as well, and it's busy, but the red dots indicate the negative return in the S&P inter-year, during the year, and then the positive return in the blue line. And so as you can see at an underline, minus 19, up 27, minus 12, up 20. So it shows here that the average inter-year drop is 13.9%. Folks, this market's always volatile, but we've had a pretty steady ride the last several years. We haven't seen as much of it, and it's going to come back. Just understand that it's just part of the game. Long term, if you're invested correctly, it's just part of it. But we have it. It happens every year, and those red dots indicate those negative returns that you've seen in the S&P, and this is going back to the 80s. And then the positive returns. And then the other thing that this chart points out is the blue lines is where we finished. So it's pretty nice to look at that chart and see that there's obviously a lot more that are up than that are down since the 80s. So how do we do? How do the markets do? This is going back to 07 to 19. The top market, the top chart is showing 40-60 stocks to bonds, and then 60-40 stocks to bonds, and then the S&P, and it's just kind of showing what happened. I like to take a look at the last 20 years at the bottom. I've got an arrow drawn there on 60-40. So 60% stocks and 40% bonds. Over the last 20 years did 5.2%. The far left is REITs, Real Estate Investment Trust. We're up 9.9. You have gold and oil in there. If I ran this chart for 50 years, oil wouldn't be in that top. It would be, the S&P would be higher than it. But anyway, the last 20 years it was due to the Great Recession. But this is the part that I like to point out. The average investor, when JP Morgan did this slide, the average investor did 1.9. And the reason for that is they just made decisions that they shouldn't have. Markets started to get volatile and it went down 13% one year and they got out, but it might have finished the year up 10. Maybe they didn't rebalance. Stock selection, mutual fund selection, those type of things. So if the average investor is doing 1.9 and a 60-40 portfolio is doing 5.2, the old saying of just get in and stay in is true. You want to have professional people that help you pick those investments, but market timing does not work. It just doesn't. And if it did, they wouldn't have to be on Fox News or CNN telling you how smart they are, because they'd be rich, right? It just doesn't work. The watch has to be right twice. It's easy to get out. It's really, really tough to get back in. And we still meet with people that aren't back in because they got out in 09 and 10, and the market's going to drop, and they're waiting to get back in again. And they just lost up on that 300% gain. So changing gears a little bit here, this is showing the top 65 to 69, 70 to 74, and 75 to 79. It's showing the labor force participation. And so you can see in 1996, that top left bubble, 22% of the 65 to 69-year-olds were still working. In 2006, it was 29, in 16, 32, and in 26, they believe it's going to be 37% of the people 65 to 69 are going to be working. So the question is why? So down here, as they ask the people why, you can see 31% are doing it because they want to buy extras. 19% want to make sure they make ends meet. But look at the 64%. Stay active and stay involved. As you guys know, I wrote Fish Don't Clap several years ago, and a lot of the reason for that book was because of people retiring and they shouldn't have. I don't have any problem with people retiring. We'll get you financially there. What we want to do is have a conversation to get people's head around what that next phase looks like. I think retirement becomes a term of the past. I think people are going to stay active longer as they get older, but they might look retired in their mid-50s. They might go to Europe for a couple of weeks. They might do those type of things. But staying active, having something passionate. I love having conversations with clients about what's that next phase look like. Not what you want to get away from, but what are you going to do? And what are the, if it's grandkids or volunteering or part-time work because you just want to stay busy or whatever it is, it's really, really neat to have those conversations. But this is showing, as they did their study and took a look at it, that trend's going to continue. Look at the 75 to 79, the blue line. 15% of the people 75 to 79, they predict in 2026, are still going to be working at some point. I thought it was an interesting slide. All right, this one's not so interesting for me. So in March, I turned 46 years old. See the 46 on that bell curve? We're the least happiest at age 46. I showed this to Trudy, and I'm like, I'm happy. She's like, what? I said, listen, I'm going to be at my lowest happiness level. I'm like, it's all up from here. She's like, how the heck do they know what that is? I mean, who are they studying to find this out? Our highest stress is at age 32, which is interesting, but the 46 stuck out. But anyway, at the very top, guys, when you take a look at amount of daily hours spent per activity, so obviously eating, drinking, grooming, home care, and household management, pretty steady. Socializing, as you would suspect, that picks up as you get older. Work decreases, and we actually sleep a little bit more when we get older too, it looks like from this study. So, interesting, but next year I'm going to be really happy. Probability of reaching ages 80 and 90. My father-in-law, Roger, is I'm going to get this wrong. He's in his upper 60s, we'll put it that. I should know the number. Anyway, he was 63, and I said, Roger, do you know if you hit 65, your chance of hitting 90 is really good. And on his birthday, he called me, he's like, I did it. I made 65, I'm hitting 90. So what's interesting about this is you take a look at the couple, which is the blue line on the left-hand side. At 80 years old, you have a 90% chance that one of you are going to hit age 80. And if you're married age 65, one of you, or 50% chance that one of you are going to hit 90 years old. And those numbers are going to continue to go up as we continue to age. There's a joke in my house, but I'm part of Strategic Coach, and they make you do this exercise about how long you're going to live, and mine's 129. So that's how long my kids think I'm going to stay alive until. So I'll be here to mess with them. Retirement savings gap. So 63% of the people think that they need $500,000 to retire in America. 63% think they need $500,000. However, when you're 65 years old, they have $126,000 saved. There's a big gap between what people think they need and what they truly have. And our job as advisors is to help people with that gap. But it's pretty interesting statistics, and again, this is from J.P. Morgan that we were able to grab from them. So we're living longer, but yet we don't have the money saved for that longest vacation of our life. There's an issue there. All right, for the younger people in here, or grandkids, or whoever, kids, this is an interesting chart as well. So the top left is $100,000. So if you make $100,000 this year for income, and you want to retire, you're going to get a 6% rate of return. Retirement age at 65, spouse at 62, 30 years in retirement you want to live. When you retire, you're going to get 5%, so you're going to get 6 today, 5 when you retire. You need to put away 10% of your income. If you make $100,000 and want to replace it, you got to put away 10%. However, if you're 45 years old, if you're me, you got to put 33% of your income away just to be able to replace that 100 grand of income at age 65. And you can kind of do the math on a chart. If you have a husband and wife making $200,000 and they're 25, they got to put 14% away. And if they're 45, they got to put 43% away. The earlier start, we all know this math, right? The earlier start, the better it is. But this starts to put some numbers behind, you know, when your kids are saying, or grandkids saying, how much should I put in my 401k? Get them to 10%. As best you can, get them to 10. For sure, take the match, right? If they match to 6, take the 6, and then get them to do 1% a year. Get them to 10. If they can get to 10, we got a lot better chance of them when they get to retirement having enough. So steps for you to take. So keep us in the loop with important changes. You know, a lot of our days is spent visiting with our clients about those changes that are happening in their lives, and there's milestones and different things that come up. Use us. Give us a call. Let's sit down. Let's have a conversation about those changes. Tell us about any concerns you have regarding your investments. Things are going to be more volatile. If you're having trouble sleeping at night, you need to call us. You should have called us before then. But let's sit down and go through that Riskalyze profile and see where that number is in your situation and make sure that we're in target. We can do that with you. And then make sure that your important legal and financial documents are done and up to date. So Bob Schmidt's here today. Go quick, right, if you're going to get them done with Bob. So, by the way, congratulations, too. As you guys might know, Bob is going to be done in July, at least with this phase. He's going to be on to the next phase, but he's did great work in Waseca, so thanks, Bob. But anyway, those legal documents are so important. We spend a lot of our time talking to clients about wills, health care, and power of attorneys. Do you have those things done? If not, get to your professional and get them taken care of. So if you have any questions about those things, talk to us. We're not lawyers, obviously, but we'll help point you in the right direction and get those things done. So what are the action items for us? We need to keep you informed through regular communication, and that's what that card is about inside your packet. So Facebook and Twitter and LinkedIn, if you're on those type of things, make sure you connect with us. We have a video we put out every Friday on our iWealth Facebook page. So if you're not subscribed to that, take a look at it. It's all educational. It's not about how smart Brad thinks he is. It's about, or Sean thinks he is. Sean is smart, actually. But what we're trying to do is just educate. So if you're not hooked up to our Facebook, please do so. Manage your investments according to your personalized strategy. We have a lot of great companies out there that we deal with investments, and they have to be put in the right place at the right time. And so our job is to make sure that we have that taken care of for you. Stay on top of changes in the market environment. Make prudent adjustments where necessary. We meet regularly about that. We have people come into our office and talk about those things, so we do that. And then the elite second opinion service to handle these introductions with professional care and attention. You know, we take pride when somebody does introduce us to somebody for a second opinion, and we make sure that we take care of them correctly, and we'd never take that for granted at all. So with that, what kind of questions do you have? There was no hands. I know I'm not that good. So, but is there any questions anyone had as I went through some of the numbers? Yeah.
Do you have any kind of chart that would show the gains or losses for 4 or 8 years someone's president? You know what I'm asking?
Yeah. Well, are you asking? So you're asking a question about the president election, right?
Well,
and returns before or after? Yeah.
Gains, you know.
Yeah. So what's interesting, I don't have that slide here, but what's interesting about that, and I'll just tell you from real life experience. I had people come in. I remember this like it's yesterday. I had people come in. I can't tell you who it was, which is a good thing because I won't tell you anyway. After Obama got reelected in his second term, and they said, he's going to run this country away. I want to get out. And they got out. We tried to talk them out of it. They got out. And the market went up like 16% that year after he got reelected. Right? There were people that the market was down 800 points after Trump got elected that first day. Because they're like, it's going to, you know. So when you look long term with the stock market returns in presidential elections, it doesn't tilt a lot Republican or Democrat. It really doesn't. It's really the policies underneath it, like tax policies and different things like that. That would be maybe a different discussion or charts to look at. But, you know, the market did well under Bill Clinton. You know, there's different type of deals. Now, I've had people say, well, Brad, what about re-election and economic indicators and things like that? And we do have some charts around that on the re-election of people. And in fact, I put it in here, so let's just go there so I can show it to you. I figured this would probably come up. So I put this in here. This is from Federated Investors, so it's just a company that put this information to us, so we're taking them at face value on their numbers here. But on the left-hand side, this is showing some economic indicators. So it's got disposable income growth, unemployment rate, S&P performance, average consumer confidence, GDP, so the market, you know, the economy growing, and then a 3-year and a 4-year, and then average approval rating of that president. And then it goes down here and it says favorable indicators. So is it, again, green means it's favorable, red means it's not. And so if you look at Eisenhower, he had 3 out of 4. And then what was the result out of his 3 out of 4 is he actually won that election. And then if you take a look at Lyndon Johnson, 5 out of 5 won. Nixon, 6 out of 6 won. Gerald Ford had 2 out of the 6 economic indicators and he lost. Jimmy Carter had 1 out of 6 and lost. Reagan, 6 out of 6. George H.W. Bush had 0 out of 6. He lost. Bill Clinton, 6 out of 6. George W. Bush, 6 out of 6. Barack Obama, 4 out of 6. And at this point, when this was done, sometime this fall, Sean, I don't know, it was 5 out of 6 that were favorable on the Trump side of things. Again, is it an indication? I don't know. But that's just on the election side of things. But long-term, Republican, Democrat, it's pretty even, which is interesting. It's a really good question. I figured it's probably coming up today. So, yeah.
You mentioned in your thing there about headwinds, slower global growth.
Mm-hmm.
Is that it's just because of the overall economy? Was it with a combination of the tariffs, or what's the reason behind it?
Yeah, I mean,
because I know you look at global stocks and stuff too. So.
Yeah, it's complicated because it depends on the region. Like Japan's been in this, you know, for a long time. You had Brexit happen over in England. Could be positive, could be negative, right? Depends on how they work. So far, it's been positive. But the trade deals, you've got a trade deal that's probably coming with Britain at some point, or the EU, and what does that look like? And so negative rates, so they're paying people to put money in, you know, so I give the First National Bank money or the Legion Bank money, and they're going to pay me, you know, it's just really weird on how their interest rates, you know, we put it in and we complain about 1%. How'd you like to put it in and pay them 1% to take your money? It's just, so anyway, there's some different things that are going on.
Yeah, and then I was just wondering, you know, because of this virus thing they're talking about too, it seems like there's a lot of uncertainty.
Yeah, the question about the coronavirus, I'm by no means an expert, but it seems like people are all over the place on this. I tend to be more of a glass half full kind of guy. I think I have to be in this environment that I live in. So, you know, I'm hopeful that here at home we take care of things and stuff, but there's other people that are screaming this could be a pandemic. And so, yeah, that could have a big effect. That, you know, that would be one of those geopolitical maybe type things that could happen that could affect things. I think you've seen, like, didn't Apple come out recently and said that they're going to have trouble with their iPhones and building and things because they couldn't get their supplies out of those places. Just when I walked in here, there was somebody that works here at the university that's went over there for the Chinese New Year's and can't get home. He's stuck over there. So, yeah, it's interesting, but no one knows on that one, right? I always go back, guys, to 9/11. I had somebody in just the other day. I was telling them, I thought it was different. In fact, we were talking about the coronavirus, and I thought it's different this time. And I'm like, it's the 4 most dangerous words in investment. It's different this time. And I didn't say that. Sir John Templeton said that. But it's true. It's not different. We've been through stuff. We went through 9/11. We went through Pearl Harbor. We went through assassinations of presidents, right? We've been through some different things. But sometimes the media wants to make us feel like it's different this time. Yeah. Good question. What else?
So how high is the market going to go?
3,400, right? 3,400, Bob. Yeah. I think the biggest thing as we put these slides together, As far as how high the market goes, I think the biggest thing that I gathered as we put this together is I didn't see a recession that's imminent like tomorrow, right? That's the biggest thing when I look at these. As far as what the markets are, I think it's really important that you have your money spread out in some conservative and some growth, and you spend the bucket that is the least resistance, the one that's up and that's not down. But yeah, I don't know any better than you do, Bob. I know you're making a joke. Yeah. What else? There was a hand here. Yeah.
What about the national debt being so high? That doesn't seem to affect the market at all.
Yeah, so the question is, what about the national debt and the market? It's scary. And you know what's interesting is each party wants to complain about the other one, and they both do it, right? When Barack was in, the Republicans screamed about the national debt, and all of a sudden the Republicans are in, and they didn't do anything about the national debt. So at some point, you really look at entitlements. Those have to be dealt with, and the biggest entitlement is Medicare. So you look at Social Security as an entitlement, but Social Security, we've got a lot of kids that are coming up into the workforce to help, and they'll kick that can. They'll go from, instead of 67, you'll be 72 before you can get it. And people are living longer, so they'll be able to justify it. So Social Security, I think, will be here long. It's not going to run out like they're predicting. What I'm more concerned about is the Medicare and the health care, and it doesn't seem like anybody has that solution, to bring those premium down and things like that. And that all gets back to that national debt. At some point, when do we become Greece, right? When you look at the debt levels and stuff. So I don't know how that gets figured out, but you're right. The markets seem to shrug it off and think of it as long-term. And long-term will come home to roost at some point, but it doesn't seem to affect the markets as that calculator just keeps on trickling. It's just so cynical on no matter where you're at, whether it's Republican, Democrat, or Independent, everybody says they're going to deal with it, and nobody deals with it, right? Once they get in, they don't. Yeah.
You said it's entitlement, but it's not entitlement. We've been paying for it. We're entitled to have it, but those that they're trying to get onto it now aren't. They didn't. Whatnot. It's not that we're entitled to it. We are, but because we paid for it.
Right, and we're expecting the government to deliver those services to us, right? Because we paid for it. You're right. Yeah. It's means tested now when you do your Medicare, right? So the more income and stuff you have, the more higher Medicare premium. There's going to be some things that'll shift and go on with it, but yeah, it needs to be addressed at some point. Yep. There was another question, wasn't there? Yeah, Dan.
Just a comment. You talked about Greece a little bit. Greece did go bankrupt, right, a couple of years ago or something like that.
I don't know where that sat.
And there's a doctor, used to be a doctor in Mankato that was from Greece, and his mother was from Greece. She lost her retirement money.
Yeah.
He brought her to this country.
Yeah.
Makes you think.
Yeah, it was just a comment about Greece and retirement funds. I think what goes along with that is the underfunded pensions is a concern for me. That's a big concern. Get this, guys. So student loan, and this is not a knock on the bankers in here at all, because really I don't think, you guys don't do student loans, do you? First night, Josh, Elysian, no? So I don't even do student loans. It's kind of taken away now. So I helped a client several years ago, and we really dug in to try to find the best rate for him and his child as they were going to college. The best rate that we could find was 7.5%, and he had a cosign for his child. So you start to take a look at these universities, and we're paying $150,000 a year to go there, or somebody that's going to go on and do a lawyer or a doctorate or whatever they're going to do. And all of a sudden they've got $200,000, $300,000, $400,000 in debt at 7%, 8%, 9% interest. So it's out there and it's real on what that debt is. How do we fix it? I don't know. But we used to have government was involved a little bit more back in the day, and you could get zero cost loans and 2% or whatever, and they're kind of out of it. And now it felt like the mob to me. It felt like this person's just going to take advantage of it because these people won't pay, you're going to pay, so you're going to pay a higher rate because they're going to default. I mean, it's just kind of a really tough situation. So student loan debt's an issue, and then underfunded pensions. We've got promises we've made to people, And keeping those promises are very important, but the pensions haven't, this economy has helped, the market has helped, as the stock market's gone up since '09. But yeah, a couple issues. Any other questions? Did I do okay? Look at that, 2 minutes to 1. Hey, thanks a lot for coming. If you need any help or need anything from us, feel free to get a hold of us, and thank you.